Hello everyone, welcome to our today's session. My name is Dr. Joshua Aura, and today I will be teaching topic 1 of portfolio management under CIFA called Overview of Portfolio Management. Overview of Portfolio Management. So the first thing that I would want us to appreciate is the meaning of the word portfolio. Ladies and gentlemen, a portfolio is a combination of investments, or assets by one investor, a single investor. When we talk of a single investor, we are looking at an individual or at an institutional investor. Now, ladies and gentlemen, why will it be important for this single investor to spread the risk? Why will it be important if this investor got something like 15 million Kenya shillings? Why is it important for this person not to put all these monies in a single investment? Like, for example, he could decide to take the 15 million and put it in a house. Ladies and gentlemen, remember the old adage. You are not supposed to put all your eggs in one basket. And that is why we are saying that this 15 million should be able to buy you a bundle of investments, a bundle of assets. So it means that these 15 million, ladies and gentlemen, should be able to give you something like shares, Safaricom shares. We should be having, in this case here, KCB shares. We should be having some real property, real estate, if possible, yes. Something like, say, 7 million, just do a good property. So essentially, if, for example, if they have cleared putting up this property here, at the end of the day, there could be some conflict. Somebody, for example, claiming that this land where you put your house is mine. Go, carry your house and go with it. Ladies and gentlemen, as much as you would get a shock, it will not be as bad as the shock somebody who put the entire 15 million on that piece of land here would get. In this case, you will be having what we call a fallback position. So the major objective of forming a portfolio, ladies and gentlemen, is to minimize business risk. Business risk refers to what? Fluctuations of earnings arising out of an investment. So you have an investment that gives you 10 million in year 1, gives you 8 million in year 2, gives you 6 million in year 3, or 20 million in year 4, ladies and gentlemen, then that kind of a venture will be said to be highly risky. Why? Because the earnings of that venture are fluctuating too much. If we have an asset which will give you an earnings of 10 million in year 1, 10 million in year 2, 10 million in year 3. Ladies and gentlemen, just like the treasury bills, the returns from treasury bills is normally constant. Then automatically that particular security will be called a risk-free rate of return investment. Risk-free investment. However, you're saying that most businesses really will be having risks which will be emanating from them. And we are calling such risk, such fluctuations, what here? Business risk. Ladies and gentlemen, in topic 2, we shall be seeing that business risk has got 2 components. We have what we call systematic risk and what here? Unsystematic risk. For us, in topic number 1, this overview, we are simply supposed to know like what kind of assets do we put together to be able to do what here? To form our portfolio, And I would want us to make reference to our past papers. And the first question that I would want us to read together is May 2016, question number 3B. 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 It reads, it's evaluate four categories of assets, four categories of assets that could be used, 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 that could be used to construct a portfolio, to construct a portfolio, to construct a portfolio. So solution, ladies and gentlemen. Number one, what type of assets are we looking at? The first asset that I would want us to look at, ladies and gentlemen, is equities. We could decide in this case here to buy shares. So basically under equities, you buy shares. And of course, expect what type of a return? Dividend returns at the end of the year. Quite an important security. So you buy ordinary shares of good companies. Number two, ladies and gentlemen, you could decide to lend the money. So you buy bonds. When you buy bonds, of course, you'll receive the bond instruments. And then, of course, effectively, you'll have given money. And then at the end of the day, this is a debt. So you'll be receiving interest. It's a debt. You'll be receiving interest. Ladies and gentlemen, the next one, which is very, very important, you could also decide to buy what we call derivatives. So you could decide, ladies and gentlemen, to go and trade this money of yours in these risk minimizing financial instruments. As we shall be seeing later on, derivatives basically are financial instruments which are normally used for what here? For hedging. They're normally used for hedging. So instead of having surplus monies with yourselves, you can decide, for example, to go and buy what we call an option hedge. So we have got various types of derivatives. We have options. For example, we have what we call swaps. These are things that we'll be understanding as we get along, Number four, the fourth type of, ladies and gentlemen, asset that I would always recommend whenever you are thinking of constructing a portfolio, ladies and gentlemen, I would recommend properties, real properties. So here you could do what? Here you could do houses, you could do apartments, isn't it? And of course, you'll be receiving what we call rental income. Ladies and gentlemen, number five, in this case here, you could consider going straight away for what we call money markets. These markets for short-term lending. Like you must have heard of banks which borrow overnight. You simply give them your money overnight or 1 week or 2 weeks, less than a year. And then they do what here? They give you interest. Money market is quite different from what here? Bonds. Bonds are what here? They are long-term. Bonds are long-term. Now, ladies and gentlemen, please look at the next one. The next question that I would want us to look at, which is quite important for this portfolio management, is this question that was tested in November 2015. So please go to November 2015. November 2015, question number one. November 2015, question number one. There is a question on a portfolio management process. So they want us to evaluate the three major steps involved in portfolio management process. The three major steps involved in portfolio management process. So if a client comes to you, you as a portfolio expert, portfolio manager, what are the key steps that you will be able to go through? You'll be able to go through for you to really put up a very good portfolio for him or her and ensure that he gets whatever returns that he was targeting or something close by there. So mention there solution. So solution, ladies and gentlemen, solution. Step number one. Step number one is the planning stage. Step number one is the planning what here? Is the planning stage. So under the planning stage, of course, you must ascertain the client's needs. What does your client in this case here want? You must at this stage in this case here have the objective clearly stated. The investment objective must be clearly stated. It's very important, ladies and gentlemen, very important. So of course, as you put down the objective, it must also be quite expressive. You must be quite expressive to him, and of course, enable this person to understand the constraints, the major constraints. For example, there is no way you will come and tell me that I've given you this money, I want 30% return. I'll tell you no. There are these constraining factors. I mean, there are these circumstances. So all the circumstances must really be put down at the planning stage. At the planning stage. Remember, planning stage is that particular stage where most things do what here, where most things go wrong, where most things go wrong. So here we must ensure that we understand our clients very well and put a plan down. Put a plan down for him or her. Step number two, ladies and gentlemen, step number two is now the implementation. Step number two is the implementation or the execution stage. The implementation of the execution stage. So under this, of course, you will have to construct the client's portfolio. You'll have to construct the client's what here? Portfolio. Yeah. You construct the clients, you construct the clients portfolio by defining appropriate asset classes, doing what we call the asset what here? Allocations. Ladies and gentlemen, after that, of course, now you have to go to the last step. Step number three is where you will have to be very seriously looking at what we call the feedback. Looking at the feedback. Ladies and gentlemen, under feedback, we are supposed to be monitoring the portfolio's performances. So this portfolio performance, we have to go to the individual assets. So under the individual assets, we must be looking at how are these shares performing like? How are, for example, the rent income that they're getting from the properties, how are they faring on? So under feedback, we'll be looking at what we call monitoring and rebalancing, or just monitoring and portfolio what here? Balancing, and portfolio balancing, and portfolio balancing. So in short, you'll be making what we call adjustments to the portfolio asset allocations depending on the kind of returns you are getting from the various asset categories. So please look at another question. These are quite easy questions. You know, I like CIFA because CIFA really is a simple course. Now look at May 2016, question number 1C. May 2016, question number 1C. May 2016, question number 1C. So we have here May 2016, question number 1C, which reads, May 2016, question number 1C. They wanted us to highlight 5 benefits that would accrue to an investor who includes pooled investment products in his portfolio. Pooled, where we have got many assets, pooling resources, and giving those resources like to one manager, one person or an institution to run them. What are the key benefits, ladies and gentlemen, which in this case here are quite important for all of us to understand. So we are writing here, we are writing there. The first one, in this case here, will be risk minimization. Risk minimization because of what? These are experts. When we talk of pooled, ladies and gentlemen, pooled, investments. Having one institution or one manager running portfolios here for many individuals, these are people who have been in this business for so long. So once we entrust them with these resources, then automatically there will be very little probability of us losing. Because this is like at times betting. Yeah, for betting, those guys who are very good at betting, they really know where to place their bets. So these people will tell you that given that you guys have been able to pull together these resources here, we shall invest in this. So our assets, of course, in this case here will be safe. So risk minimization, ladies and gentlemen, we have here increased returns. Increased returns again because of what here the experience of this gentleman or of this lady who is managing the pooled funds. The pooled funds. Very, very important for us to understand that. Ladies and gentlemen, of course, a pooled fund will also offer economies of scale. Economies of scale. Because now we are operating at a higher scale, a higher level. So we shall be able to exercise bargaining power. So we'll be going, for example, to a particular asset class. The people who are in that particular asset class will be telling them, hey, look here, we have a whole 10 billion shillings. A whole 10 billion shillings we would want to put in this. So we can command. If it's a bank, we can tell a bank, hey, we can't accept 10% return, interest rate. Give us even 12. So we shall be able to enjoy economies of what here scale whenever we go for pooled kind of what here investments. Ladies and gentlemen, number 4, right for us there. Number four. This automatically will provide a reasonable degree of liquidity. A reasonable degree of what here? Liquidity. Degree of liquidity. Provides a reasonable degree of liquidity. Again, this emanates from the fact that we have got many investors coming on board. So you'll have, in this case here, this particular plan could be a pension plan, which is highly funded. So once we have a portfolio that is highly funded, whose liquidity is not in doubt, even on issues of monitoring and balancing, we shall not be having a much major issue. Because most of us, out of doing some of these investments in isolation, alone like this, if I put my own little monies in various asset classes, chances are one of the fine days I'll get myself having my daughter in the house without school fees. So what will I do? I'll go and tell this person, let us adjust this. I would want to take something from this particular counter. So at the end of the day, because of lack of liquidity, I'm forced to balance. I'm forced in this case here to do asset allocations, tactical asset allocations, without really, or rather without a great objective. Here I've been squeezed. So ladies and gentlemen, once also in this case here we have pooled our resources together, we shall access. So access in this case here to expertise services. We can afford to hire a fund manager. We can afford to hire a fund manager. Now, ladies and gentlemen, for the sake of our next class, I would want to give you a homework. Check September 2015, question number 3. September 2015, question number 3 is your assignment, which I expect you to do. And if possible, you simply post it on our WhatsApp group. So September 2015, question number 3 reads, in relation to portfolio management, explain the meaning of the following terms. We have a passive portfolio management. Passive, where you're not involved. I would want to see how you guys will define those things. Number 2, active portfolio management. Number 3, tactical asset allocation. So that is your homework. And of course, that marks the end of what year, this particular introduction. And please don't forget, when you talk of portfolio management, basically the overview, we need to know the definition. We need to know, ladies and gentlemen, this concept of what year, this concept of the process itself, the process of managing this portfolio. We need to know the various categories of what year assets, various categories of assets. And then, of course, it will be very important for us to think about what we call the investment policy statement, IPS. IPS is also an important statement. It's an important statement that we have to put down with our investors. Those policies must be documented very well, Otherwise, I want to take this opportunity to thank you so much for having listened to this particular clip, especially for those of you who are following us on Facebook. Please share. It's important that the public gets to know that RCM now has entered this great industry of CIFA, great industry of what year? CIFA. So please share and don't forget to support us. God bless you.